Hey everyone, and welcome back to this explainer. Look, if you've been pulling your hair out feeling totally frustrated by the markets lately, trust me, you are definitely not alone. Today, we're diving deep into the market data for the week ending July 17th, 2026, and we're going to uncover exactly why all those breakouts you've been chasing are just failing. But more importantly, we're going to focus really heavily on the playbook of the pros, how smart money actually manages risk to not just survive, but literally thrive in these exact tricky conditions. Because here's the reality. Right now, most retail traders are just bleeding capital. And why is that? Well, it's mostly because they're sitting there staring intensely at 5-minute price candles, desperately trying to predict the next big breakout. It's essentially a guessing game. But the professionals, the smart money, they aren't predicting a single thing. Instead, they identify the current market environment, they patiently size down their risk, and they just wait. It's all about managing risk, not gambling. Okay, let's dive right into this. We're going to start by unpacking the retail trading trap. Then we'll look inside what we call market equilibrium. And after that, we'll track those crucial institutional cash flows. Finally, we'll weigh the global macro gravity before wrapping it all up with a masterclass on professional risk management. All right, part one, the retail trading trap and exactly why your breakouts are failing. So, trying to force trades right now? That is a massive, dangerous trap for amateurs. Just looking at our baseline structure for the week, the Nifty 50 closed at 24,334.30. And sure, while the Bank Nifty did show some really strong participation, putting in a pretty solid close at 58,521.40, here is the absolute critical takeaway you need to hear. The broader market is just completely lacking any kind of aggressive directional expansion. So what exactly are we experiencing right now? It's called market equilibrium. Basically, price is just being digested. The market ran hard, and now it's just catching its breath. And because we are totally lacking that aggressive directional expansion, well, chasing massive breakouts right now is frankly mathematically flawed. The momentum simply isn't there, guys. Which brings us to section 2, inside market equilibrium, and the all-important sector rotation. Now, what's really interesting here is that when the main index stalls out, the pros look right under the hood to see where the capital is actually flowing. During an equilibrium phase like this, capital rotates based on relative strength. Just look at this week. We saw a very clear flight to specific sectors. The IT index was a real standout, advancing 1.75% and making it the strongest performer. But on the flip side, Pharma faced some incredibly heavy distribution, dropping by 1.40%. The smart money isn't just blindly buying the whole market. No, they are rotating precisely into IT and pulling out of Pharma. Moving on to section 3. Institutional cash flow divergence. So who's actually controlling this equilibrium? Seriously, if capital is doing all this rotating under the surface, who is actually behind the wheel of this price digestion phase? The cash segment divergence from Friday is honestly incredibly revealing. On one side, foreign institutional investors, the FIIs, were net sellers, pulling over 376 cores straight out of the market. But wait, they didn't crash it. Why? Because domestic institutional investors, the DIIs, immediately stepped in as net buyers, absorbing over 1,017 core. It's this exact push and pull, this juxtaposition, that creates our equilibrium. And what this wild divergence clearly proves is that smart money is simply rebalancing. They are not panic selling, right? And they certainly aren't aggressively buying up everything in sight either. Think about it. If the giant institutions who control literally billions of dollars aren't panicking or aggressively buying, you definitely shouldn't be either. We really need to mirror their patience. All right, let's look at the bigger picture in section 4, global macrogravity and the current headwinds. Remember, the Indian markets absolutely do not operate in a vacuum. We've got to look at the global headwinds. Case in point, the U.S. 10-year Treasury yield closed the week at a pretty lofty 4.55%. Now, think of this elevated yield just like gravity. Just like heavy gravity makes it way harder for a rocket to launch into space, a 4.55% risk-free rate acts as this massive gravitational pull on global equity valuations. It seriously restricts just how high risk assets can actually fly. Now combine that heavy macro gravity with an India VIX that's just resting down at 13.15. When you take these two isolated data points, that high U.S. Treasury yield and a super low India VIX, it essentially compresses the entire market. It creates this highly restricted, really low volatility environment where things just kind of get stuck. Which perfectly sets up Section 5, professional risk management, and something we call the 0.5% rule. So the crucial point is,
How on earth do you adapt to everything we've just covered? Well, you have to completely shift your entire focus to capital preservation. First off, recognize that a VIX sitting near 13 dramatically increases the probability of false breakouts. The math, the actual edge, is just not in your favor right now. And this is exactly how smart money manages risk. If your standard risk per trade is usually, say, 1%, you must dynamically adjust that down to 0.5% during these low volatility regimes. Why? To avoid those brutal consecutive drawdowns from the inevitable whipsaws. Honestly, sometimes the most professional, smartest decision you can make is to literally just sit on your hands and stay in cash.
There's a saying I absolutely love. The market doesn't reward better predictions, it rewards better decisions. This is the ultimate philosophical pivot, guys. It's about moving away from forcing trades based on some random hunch and instead actively protecting your capital when the data is screaming that the environment is hostile. So I'm going to leave you with this somewhat provocative question as you head out to navigate the week ahead. Are you predicting or are you deciding? Please don't force a trade that simply isn't there. Size down, manage your risk exactly like the smart money does, and preserve your capital for when the market finally starts to trend again. Stay disciplined, stick to the data, and if you found this explainer helpful, make sure to subscribe for next week's intelligence report before you place your next trade. Catch you next time.